This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, Managing Editor of Real Estate here at Momentum Media, the team that brings you the Smart Property Investment Show with my co-host,
Emilie Lauer.
Emilie Lauer. And, you know, the funniest thing is we've been working together for quite a while.
Yeah.
And it was only after we started chatting on the podcast, I was calling you Lauer.
Yeah, it's it's very common. Even French people have difficulties to pronounce my name. The R is very strong. It's Lauer.
Lauer. And the way
good.
that you told me to learn it was air, A-I-R.
Yeah, A-R-R. That's difficult for me to pronounce, actually.
See, when I was writing it down, I was like L-O-E-H, no, Lauer. But so all of our readers would know your name on the Smart Property Investment website where they're getting all of their market intelligence on investing in property as Emilie Lauer. You now know it's Lauer. And we are joined today by a very special expert that's going to be taking us on the journey of, well, her property investment journey, but also the journey of investment through self-managed super funds. The one and only Olivia Long, founder and CEO of SMSFAI. Welcome to the podcast, Olivia.
Welcome, Olivia.
Thank you so much. What a great entry.
Well, you know, we were having a bit of a look through your bio earlier, Emilie, and we'll be getting into this a little bit later in the podcast. I'm not going to run before I walk, but using artificial intelligence in the world of SMSF, I think a lot of people are going to be very excited about that. And I know you've been doing some podcasts with some of our sister publications here at Momentum Media, including Accountants Daily. So anyone that wants to learn more about that, also jump on there. We'll add that podcast into the show notes. But Olivia, to start us off, give us a little bit of background into your journey, a little bit of background into what you're doing at the moment.
Okay, so I suppose to start with, I always wanted to work. I was ready to get going. So I had my first job when I was 13 and I wasn't afraid of hard work. So I finished school early at the age of 16, went to uni, came out and stumbled into stockbroking as my first job. So that was quite good in terms of understanding investments and sort of an entry-level role to the market. From there, I fell into self-managed superannuation and I've spent 20 years in the industry looking after people with self-managed super. So thanks to my first job in stockbroking, though, I was able to acquire my first property, my first investment property at the age of 21.
Wow, that's fantastic. And I do have a bit of a question because already it seems that you have such a strong basis in your career that has enabled you to go on this journey. And I know this is really early on in the podcast, but would you have a tip for someone that didn't necessarily have that level of financial basis or financial understanding about they might be looking at property now? Yeah, they're looking at it, where the hell do I start? Would you have a few tips on where they can begin their journey?
Yeah, absolutely. Well, for a first home buyer, back in my day, we didn't have the first home buyer's grant available. So obviously, if you can take advantage of that, my recommendation is try and do so because it will enable you to get into the market sooner rather than later. And we've all seen how quickly the market moves. But the second piece of advice I'd give people is engage with experts to help you decide on an investment property. If it's not going to be your home in particular, and you are using it solely as an investment, take the emotion out of the equation and speak to experts about where to buy and what to buy. One of my mistakes on my journey was I acquired an apartment along the way. All of my properties significantly increased in value over, say, a 10-year period. The apartment stayed exactly the same.
Wow.
So apartments don't tend to appreciate quite the same as property, which I'm sure you already know, but as a first-time investor, I didn't.
Let's go to your investment journey and let's go back to your first property. So tell us about when and where did you buy it and did you live in it? How was the story behind?
Yeah, absolutely. So I'm quite fortunate in that I bought my first property and my mother actually lived in it and rented it off me. So I had a good tenant. It was going to be a long-term tenant and I sort of had that safety factor, which made it easy. That property I didn't live in, but I held for about 15 years and I acquired that for $90,000 and when I sold it was $380,000. Had I kept it, today it would be worth $700,000. So that's always a shoulda, coulda, didn't. But yeah, So that was the first property. And from there, I used the equity in that to buy another property. That was in country Victoria. Again, I had a known tenant, long-term tenant. So I acquired that for, I think, around $80,000 and sold that for close to the $400,000 mark when I was ready to move on from that. So there's been a process of buying properties and sort of selling them sometime on. If I could do it all again, I would buy and hold. I'd stop selling and realising the CGT to try and buy something else. I'd be smarter about where I bought. I'd get advice on where to buy, and I'd just buy and hold.
A lot of that research piece is something that Emilie and I hear quite a lot of, that you need to know where you're going and surrounding yourself with that expertise and that A team that can support you on your journey. Now, a bit of an odd question, but I can imagine that if you knew your tenants, especially your mum, it might have made potentially passing on rent increases a little bit awkward. Do you see there being any challenges with having tenants of people that you know? Could it make the relationship a little bit hard?
Potentially. I'm quite a firm property owner. So, you know, what it has to be. But the thing that I did in knowing the tenants, I was happier to make improvements to the property. So invest in its maintenance, putting in new bathrooms, new kitchens, and sort of doing them up over time was sort of part of the journey. And all of that helped to, increase the value of the property. But the big advantage of knowing the tenants and having long-term tenants is they took care of it as if it was their own. And the gardens and the property and the maintenance was all, it was immaculate. So that was one of the advantages, I suppose.
Olivia, you mentioned the property you bought, you rented it. So did you finally end up buying a property for yourself to live in?
Yes, I did. Yes. So I bought the family home some time ago and we're still in it. It's more than doubled in value in Adelaide over that period. It's in a great suburb. We're happy. The emotional component is there. I need to be by the beach. So I'm by the beach, but I don't think I'm going to be moving far in a hurry.
Now, your day job, you're investing through SMSF and you've been working with SMSF for over 20 years. How has it changed over the years? And looking at investing in property through super, what are some steps that people should take? What are some mistakes that they should avoid? Where can they start?
Okay, so how I've seen it change over the 20 years is a lot of SMSFs used to invest in collectibles. So unusual assets like artwork, wine, vintage cars, taxi licenses, you name it. We've sort of seen it all over the years. But the ATO changed the rules on it, and collectibles are sort of no longer as easily held as they used to be. In terms of property, when they introduced the limited recourse borrowing rules, that was probably the most significant change to super that I've seen. And what I enjoyed about that is what started out as being extremely complex has now become mainstream for specialists like myself and my peers, which is a good thing. And I've seen a lot of people acquire property with their super, and of course it's enjoyed just the same capital gains as everybody else has. And by taking the opportunity to leverage and borrow to do so, they've really been able to boost their retirement balance earlier than they otherwise would have been able to, due to the contributions caps that are on the amounts that you can put in super. So the government, the superannuation vehicle is the most tax-effective vehicle in Australia. Therefore, the government, and fair enough, have rules and regulations around how much you can put into that environment. So borrowing is the only way that you can get extra money in and make the most of that tax-effective structure.
For people that aren't necessarily intimately understanding of how to use this as a vehicle to acquire a property, can you give us a little bit of snapshot? So a little bit of snapshot into those contribution caps. Can they live in it? Can they rent it out to someone they know?
Okay, so some of the key rules around investing in property is you can't rent it out to anyone you know, you can't live in it, and you can't use the property at any point in time. So, for example, you can't buy a beach house, Airbnb it, but then go down and actually use it at some point. That would be breaching the rules. It must be on completely arm's length terms. So you would acquire a property and appoint a property manager to look after it for you. Again, take the emotion out of it. It's that set and forget sort of strategy. They're predominantly the main rules.
And the contribution cap to your to your super fund more broadly, that is, and my understanding of it isn't not necessarily quite there, but that's because you're taxed at a lower level for your contributions to your super fund. So there are limits to how much you can put in there.
Yeah, so there's two things. There's concessional contributions that you can put in from pre-tax dollars. So that includes things like your superannuation guarantee that your employer pays, or any money that self-employed people might contribute to super. And then there are non-concessional contributions that are after-tax contributions. Now, even with the non-concessional contributions, the maximum that you can actually put in per annum at the moment is $120,000 per annum, or there is a special rule where you can bring forward 2 years worth of contributions and contribute $360,000 in one go, but then you can't contribute for the next 2 years. So if you've got a strategy that you want to implement with your super, you really need to sit down with an expert and plan out the timing of when you're going to be able to contribute and how much. The other thing with the self-managed super fund is those contribution caps are per person, and you can have up to 6 members in an SMSF. So quite often you'll see, a husband and wife or 2 spouses, and they would both be making that bring forward contribution rule. Say if they were to inherit some money, we see people try and get into the super environment. From there, any income or capital gains that is payable on that property in accumulation mode is taxed at just 15%. That's significantly, obviously, lower than your average Aussie person that's paying income tax. So that's the advantage of holding it in super. But the main advantage is if you buy and hold a property until you actually need to retire, you can commence a pension in your self-managed super fund and convert that property into an entirely tax-free environment. So what that means is you don't pay capital gains tax and you don't pay any tax on the income that you get from that. So it's quite a nice way to have regular income coming in so that you can pay yourself pension payments from your SMSF, but also that big advantage of not having to realise the CGT. Because if you're buying a property age of 40 and you're retiring at age of 65, as an example, the property's bound to increase significantly over that period of time.
Absolutely. And I'm sorry, because you've opened up so many questions. This is so fantastic. The first one is, Emilie and I were actually talking about this very recently about, you mentioned that there's a cap of 6 people. So notionally, is this something that you would be able to marry up your super fund with someone else, not necessarily a spouse, maybe a friend or a sibling, and acquire a property together?
Absolutely. Quite often we see family funds. So mum, dad, 2 siblings, so you've got 4 members in the fund, and they pool their money to acquire a property. The only complexity that needs to be considered is if one of those members wants to get out of the fund, or if one of those members die, you're going to need to sell the property and realise any tax at that point in time in order to pay out the death benefit.
Okay.
So you really need to get some advice or give some consideration to why you're buying the property, how long you're going to hold it, is there other cash or other assets in the fund that are more liquid that you can dispose of if a member does end up departing the fund. There's certainly a lot to consider if you're going to pool, but it's a great way to spread the cost and reduce the cost per member, but also leverage your super to buy an asset that you really believe in.
Great. So let's go back a little bit through your investment journey on the SMS fund.
Yes.
So what properties did you buy through your SMSF? And at this point, what were some of the challenges you found yourself?
Okay, so the first thing is the rules around borrowing to buy property are that you can't buy a property and then make significant enhancements to it. So you can't buy a property and actually do it up. So renovations, you can't make changes to the underlying assets. So most people, when they're borrowing in super, tend to buy a brand new home. Or you look for properties that aren't going to need any sort of improvement in any short term. So that's the main thing. The other hard part is that a lot of people tend to turn to their accountants when they're establishing a fund or looking to borrow for property. And the accountants generally aren't experts in that field, so they'll engage a lawyer to try and help them. So we've seen people literally who've spent in excess of $20,000 to set up a borrowing arrangement where we would do exactly the same thing for $2,000. But people don't know what they don't know. and that you generally trust your accountant. So that's probably the main thing, is understanding the legalities don't have to cost you an arm and a leg. You just need to make sure you're speaking with the right people, and your property really needs to be some sort of new home or a new asset. The other key rule that comes to mind is when you're borrowing, you can only borrow to acquire one asset. So you can borrow to acquire a house, but not 2 units or not 6 units. You would need a separate borrowing arrangement for each unit in that instance. So it can be complex, but if you seek the right advice, then tell us what it is you're trying to achieve and we can find a way around it.
And throughout your journey, you would have picked up no shortage of lessons that you could pass on to people. What are some of the tips that you could pass on to people that might be looking to use their SMSF to invest in property? And then on the flip side, I'm going to give you a double question with the tips on one hand, but also there must be a series of challenges that people would face along the way.
Yeah, 100%. So the first tip would be shop around and find a mortgage broker that understands SMSF, because part of the challenge is because it is so complex, the mainstream lenders don't all lend in this space. So where you can actually source the financials from, may vary. The other challenge is that there can be high upfront costs, as I mentioned, depending on who you deal with. And of course, you need to be able to ensure that any ongoing costs, such as property management, maintenance, etc., can be covered from the contributions that are actually coming into the fund. So you're going to make sure it's going to be cash flow positive with a self-managed fund. But the biggest risk is really the sole purpose test, and that is making sure that the property's only used by non-related parties. So making sure it ticks all the compliance boxes and you're not breaching those rules would be the main thing.
So we're going to go to a quick break, and when we're back, we're going to unpack Olivia's recent venture with SMSFAI. We'll be back in just a second. Liam Garman, Emilie, Lauer and Olivia Long on the Smart Property Investment Show. Olivia, you've recently launched a new venture, SMSFAI. My co-host Emilie, goodness, I've got so many people I'm speaking to. Well, looking through it seems very exciting for you. Talk us through what you're up to at the moment with this venture.
Okay. Well, I like to think of myself as an innovator. I like to do something that's cutting edge. In SMSF, sort of 15 years ago, it was going offshore in terms of finding accountants, because it is a challenge for people in Australia. But earlier this year, I launched SMSFAI because I can see what the future holds with AI, and I've decided to be a first market mover and get into that space and embrace it with tenacity. So from someone that didn't know a lot about it, I certainly learned a lot in a very short space of time. But the first thing to note, just quickly about the SMSF sector in general, is that it's just tipped $3 trillion. So the ATO are well aware now that it's a significant sector and they have very little oversight over it. People are still lodging returns annually, and they're not happy with that. So at some stage in the near future, self-managed super funds are going to move towards at least quarterly, if not daily reporting.
Daily?
Correct.
Whoa, okay.
And that's going to be difficult to achieve when you've got people that are allowed to have assets that are outside the square, like property or, cryptocurrency, whatever it may be. So with that in mind, I'm using AI for several key purposes. The first is to automate admin tasks. So by automating admin tasks, it gives me more time to spend talking to clients, and that's what it's all about at the end of the day. And I'm very passionate about saying AI complements the professional service. It doesn't replace it. Because I can guarantee you when people are talking about their retirement savings and they're trying to get their head around borrowing to invest in super, they're going to need to talk to a person and someone that knows what they're talking about in order to gain that level of trust that they're making the right decision. In terms of compliance and risk management, AI can facilitate making sure that the SMSFs remain compliant, and they can alert you to any compliance breaches that might happen as they happen. So, for example, people putting in too much money into super can ring a red flag, and you can say, if you identify a problem when it happens, you can fix it. And in that scenario, for example, you would tell the trustees just transfer the money out. Or you would deal with the issue when it arises. Once you wait till after the end of the year, it's far harder. AI enables you to give better client service. So in terms of personalised communication, personalised information, I use AI software and I'm the only administrator in Australia that provides video reporting to trustees. Now, I think that's important for two reasons. One is that research indicates that people retain 95% of what they watch compared to just 10% of what they read, which I think is amazing.
I think that would be very, very, very thorough in financial documents and reporting documents where you're going page by page. You're like, what the hell am I reading? This is so dry. 100%. This is so boring. Yeah.
Trustees look at financial statements, and unless you're an accountant or a business owner, you really don't understand what any of it means.
I don't even think I read the contract for my mortgage. I think it's like sign here and it's like dotted. It's like, oh, none of this means it's all legal language.
That's what happens, and everyone's got electronic signing now. So less and less people are actually stopping and going, hang on, once a year, how did my fund actually perform? Is this super fund working for me? How does it compare to the rest of the market? Did I do better than last year? Key questions that trustees should be asking that they're not because they don't understand the information. And I'm passionate about taking complex information and making it simple. So the video reporting is a key benefit that my clients love. Like most of them watch the videos several times over and then sit down, and it's a call to action. Let's actually look at what we're doing with our fund. What could we do better? AI enables advanced financial analysis. So as we move forward, we're going to see a lot of technology come out that can better predict where markets are going to move or how something's going to perform. So that'll be interesting. But also SMSF admin in general is made so much easier these days by AI, which can handle all of the bookkeeping, all of the document collation, etc., on behalf of trustees. So with an SMSF, you do need to have an annual audit conducted on the fund to make sure that because you're accessing your super, you're doing everything within the legislation. And these days, administering a self-managed fund and satisfying audit requirements is made so much easier with the use of technology.
And it seems like this is going to give people the information that they need to make the most of their super fund. I mean, even looking at myself, I look at my super fund so irregularly, and being a lazy millennial, I thought, I've got many.
I don't even think I've looked at it once, to be honest. Yeah.
Tell me what your balance is.
I do know it, and this is why it was heartbreaking because I ticked. I thought, well, I've got so many years left in my working career, fingers crossed, that I was like, oh yeah, go in the most aggressive fund possible. And I looked at it only a couple of months ago, maybe. I'm like, oh, I'm paying the damage of going in the most aggressive fund I can, because that's dangerously low. I'm not retiring anytime in the next 40 years. So the idea that you can use technology to let people have the information they need to harness their super fund to make it work for them, because it is their money in the long run, I think that's a fantastic thing. And if you do have those requirements moving to, say, daily reporting, but you've got like really illiquid assets, right? You do need to harness AI. Olivia, a $3 trillion industry, it's quite mind-blowing.
Absolutely. It's huge.
Yeah, and with the opportunity for people to make it work for them, I think it's very good.
I'm actually quite curious, Olivia, because you've been managing SMSF funds for 20 years, so AI is quite recent. How much time are you winning now that you're using AI in managing those funds compared to before?
Oh, time savings are significant. I've still got a lot of AI that we're developing in the background because it is still a relatively new venture for a lot of people. And even with our software provider that I work closely with, they've got a lot of AI development going on at the moment as well. So I think the next 12 months to 2 years, we're going to see things sort of go from 0 to 100 very quickly. But I'd say rather than time savings, at the moment, it's probably saving me on staff costs. And it's also, I'm able to provide better solutions to my clients using that technology, if that makes sense.
Now, I don't want to ask a hard question, but I've got to ask it. Are there any, because we've heard all the good side of the story, are there any risks associated with using AI for this kind of thing?
Absolutely. So there's data privacy and security risks as a main thing, especially when you're looking at people's super and their personal financial information. So because AI essentially requests access to that data, so it increases risks of cyber attacks or breaches. So you need to have a safe infrastructure around that. As humans, though, we still need to be very careful of over-relying on automation because AI is still pretty new and there can be errors or things that actually require human judgment. So at this point, we still have a layer of SMSF managers that do oversee what the AI is doing for that reason, just to make sure that they're actually making correct assumptions. And there's also this thing called black box algorithms. So AI will do things, but you don't know why or how it's done it. There's not the transparency there that you would if you had a human there and you said, how did you do that? And they could explain it to you. So that's another complexity, but also there's system downtime. So if you're relying on AI and the system goes down, that's a bit of a pain. But really, it just comes down to data security and having that level of human oversight at this point in time.
And I think utilising AI in these things, it's never going to replace the human. It's almost to a point making the human's job easier because when you go right back to the basics of automating those tasks, it frees up, say, Olivia Long's time that she's not wasted doing the manual, laborious stuff. She can sit there doing the top line thinking. She can sit there making sure the strategy is correct, making sure she's delivering for her clients. And a lot of the stuff that you would have just wasted hours and hours and hours of the day doing is kind of taken out of your hands now. And
absolutely.
And you can fact check it and you can look over it and you can make sure it's all right in a fraction of the time. And that makes total sense. We're going to go to a quick break. And when we're back, we're going to be talking about what Olivia calls a women's wealth revolution here in Australia. We'll be back in just a second. Liam, Garman, Emilie, Lauer and Olivia Long here at the Smart Property Investment Show. Take us away, Emilie.
Yeah.
Let's ask about the women's wealth revolution.
Yeah, Olivia, you've celebrated what you've called the women's wealth revolution here in Australia, as women are projected to inherit a significant portion of a 5 trillion wealth transfer over the coming decades. So can you tell us more about that?
Absolutely. So, as we just said, in the coming decade, we're going to see a $5 trillion transfer of wealth from one generation to the next. Now, a JB Weir report recently highlighted that women are expected to inherit 65% of that wealth, which is huge. That trend is also further supported by what we now call the older daughter effect, where the eldest daughter is now assuming control of the family finances, whereas traditionally years ago, it was always the eldest son. So we're seeing a huge shift in that area. So it's not just about women inheriting wealth, it's about women making financial decisions that have traditionally been the male domain, because times have drastically changed, obviously. So in fact, these days, women now graduate from university at higher rates than men. And listen to this one, women are becoming millionaires at twice the rate of men.
Okay.
So they're no longer just participants in financial world now, they're actually leaders. So this wealth transfer is really an unprecedented change for women to influence how wealth is managed, how it's invested and how it's preserved for future generations.
How do you think women will impact the SMSFs market and the property investment market in the future?
Okay, at the moment, women are outpacing men in property purchases, which is interesting. And they're leveraging real estate as a vehicle for long-term wealth creation, which is great. In the SMSF sector, we're seeing more women step up as trustees as well, using their super to not only invest in property, but to diversify their portfolios and take control of their retirement savings, which is great. So the financial empowerment that they're getting is actually redefining how they approach wealth creation with confidence, which is fantastic. So with SMSFs now managing over $1 trillion, as I mentioned, women are better positioned to decide how to use their retirement savings to make the most for their financial future, which is great.
Those are pretty startling statistics. What do you think the genesis of these rates have changed? Where do you think they've come from?
Oh, where do they come from? I think these days women get the same access to information and education as men, which wasn't the case with my parents' generation even. So they're as savvy, we're equals in every way these days, and they're as savvy as men at how to make investments and potentially just more driven. But there's this thing called the eldest daughter effect, which I mentioned. And I think, the eldest daughter is helping their parents generally as they age on a number of levels. Managing their finances is just part of that. So, women are just more savvy at the end of the day.
There's been a fair bit of research done on that as well, in terms of even in managing household finances, women typically do take a leading role on that. And even in my own home, I think I'm a little bit smooth brain when it comes to a lot of this stuff. So I defer a lot of our home finances to my wife because she's better. She just understands it more than I do.
In some culture, the women deal with the finances altogether, which is quite impressive too.
Yeah, I live off an allowance.
Oh, good.
Yeah. It's a way of saving money. I get my weekly allowance, so it's a good way of saving money. Olivia, what's next on your journey?
Okay, well, at the moment, I'm in a bit of a holding period, to be honest, because I feel, the property market is so high. I'm really trying to decide what is next. But I think, unlike traditional superannuation vehicles, with an SMSF, you've got the opportunity to diversify and play in different areas that you otherwise wouldn't be able to. So, for example, cryptocurrency is one area that I've got part of my portfolio exposure to at the moment.
I bet you're cheering about that. I
was very fortunate. I got on the Bitcoin journey very early on because of my role in superannuation and the need to understand it. So, definitely cheering, happily amazed. But that's one of the beauties about self-managed super is having the control to just decide where you're going to invest it and take it, and take a risk. And I was happy to take the crypto risk, 10 years ago when I was retirement. It still does seem a fair way off. And that's why I think the younger generation like it so much. And we are actually seeing the 25 to sort of 44-year-old demographic is leading the way with SMSF establishment at the moment. And again, I think it's because they're not afraid to take a bit of a risk, because not only is the superannuation that they're being paid higher than what we were when we first started getting super guarantee, but, they've got time to retirement. Time is their friend, so they're able to diversify and try some things. But at the end of the day, some people, I love bricks and mortar, and it's done well for me over my entire journey, but I can afford to offset some of that with a little bit of a risk on other assets, which may or may not pay off. But either way, I'm making the decision, and that's what I like at the end of the day.
Whether some assets pay off or whether they don't, it's really no different for, the example that I gave before where I ticked, invest in the most aggressive fund for me, and I've probably performed less well. So look, Olivia, thank you so much for your insights, and thank you so much for joining us on the podcast today.
Thanks, Olivia.
My pleasure.
That was Olivia Long, founder and CEO of SMSFAI. It's been a pleasure to have you on the Smart Property Investment Show, and we'll be back at the same time in just a few days. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.